One of the things to remember is that as a good investor or trader, you never want to be emotionally biased, right? So
Yeah.
when I say I'm bearish in this next 3 to 6 months, it's because the chart is telling me that a wild market, really the last, almost the last week, ever since Netflix was down 37% on earnings, the market has been just so jittery. And I think that's really what's gotten to the market. So today after the bell, we had Google report, Alphabet as it's known, but I always call it Google,
Yes.
and Microsoft, right? And then tomorrow you have Facebook, and then Thursday after the close in the US markets, you have Apple and Amazon. So the way I look at it is after this Netflix report where it got clobbered down 37%, the market is really nervous about these reports, especially when you have these trillion-dollar companies where if they were to drop like that, I mean, it could crash the market, right? So the market is very on edge as we get into these reports. Initially, we saw, so Google sold off, or Alphabet sold off sharply on earnings. We then saw Microsoft initially go up, then go down. The markets were getting crushed after hours here. And then Microsoft came back and is now up nicely. So it's kind of saving the after hours here. Who knows what happens tomorrow? Can we stay involved? Can we stay long the market when you have these reports coming out? And any one of them could blow up and create a big market sell-off. So it is wild right now. And that's not, I didn't even mention the Federal Reserve next week is potentially raising interest rates by 50 basis points. I think the markets, weirdly enough, I think the markets are expecting that. If the US stock market sells more heavily going into that, the Fed may even be slightly less hawkish, which obviously could give the market a little bit of confidence. But again, this is a wild time in the markets. I mean, you mentioned Tesla getting crushed. I mean, it is just nuts out there. Yeah, so I think that for safe purposes, and again, commodities is a little tricky to kind of group everything as a whole, but if you're looking for safety, I really think gold is the place to be right now. Silver, platinum, maybe a little bit, but gold is really the safest play because it's not really an industrial metal either. So it's purely a play for safety, a play for inflation hedging, which is really the safest place in this environment. We know Bitcoin's still going down. We know that stocks are going down. We know that there's lots of other issues out there. So I do think that skewing it more towards the metals is the right move right now. Now, that's not to say there's not opportunity, right? So you look at a stock like Netflix, which is now trading at about an 18 or 17 PE ratio. I never thought I'd see the day, frankly, when that was the case, but here we are. And, you look at how oversold it is. And so there are opportunities if you're a little shorter term, if you want to hold it for maybe a month or two, where I do think you'll get a 10, 15, 20% bounce. Same thing maybe for Meta, which is Facebook. The stock is just getting rocked in the after hours today, was at $175 a share, and that's down from 380,
Wow.
not that long ago. So I mean, there are quality names which are getting in the value range, but I strongly encourage people to not think about these as long-term holds yet, because I still think the Fed is going to continue to tighten. I still think eventually they're going to cause a recession. And I think these stocks will bounce, but then likely eventually head back and go lower. I think that's the play is to buy quality stocks, the ones we've always heard about, the Netflix, the Facebook, these type of plays down in these low levels, very near the lows, and then just kind of look for that big bounce, which should come in the not too distant future. In fact, the stock market and some of these tech stocks are hitting some major technical supports in this range. But again, I do worry that it's just a shorter term bounce. So if you're someone who doesn't really look at the market on a daily basis, you may just want to sit in gold or some commodities, or even just sit on the sidelines. Nothing wrong with being in cash and being ready to jump on a great opportunity when it comes up. Yeah, so I'd be so surprised if we avoid a recession by the end of this year or next year. It might just be kind of on the tip by the end of this year. But the Fed is definitely going to be acting aggressively, and then you have to look at the stock market. And if the more aggressive the Fed acts, the more the stock market is going to decline. The more the stock market declines, the less money people have, or they feel less wealthy. Right, the wealth effect that was driving the economy for the last couple of years. So you are going to see at some point, after this COVID initial reopening spending kind of dies out, I think people are going to say, wait a minute, and listen, the NASDAQ's down over 20% now. I mean, if we do another 10 or 20%, that's a hefty drop. People's 401ks are going to be down sharply at that point, and they're definitely going to take a second look and think about, spending as much as they were initially. I think very logically, I follow the charts. So like, when people were buying these stocks when they were at all-time highs and, you turn on the TV and everyone's like, oh, these are the greatest stocks in the world. I'm like, oh my God, these things are so scary to me. Like the price to earnings, price to revenue, and all these type of metrics are just way out of whack. And now people wait for them to fall down sharply, and then they're like, oh my goodness, now I have to exit. So again, it's all emotion. We know the stock market is driven by emotion, greed and fear, right? The two most powerful emotions for us as humans. And that's what happens. And you're right, the snowball effect, as it goes down, it catches more people throw in the towel. You have institutions that at some point are unloading and they're throwing in the towel, and it just becomes a very nasty event. Gold had broken out and it went to about the double top, right? So I'll draw in some trend lines so we're all on the same page. If we take a trend line right here, this was your initial breakout, right? And remember, Kerry, we talked about how the price action in gold from 2018 to 2020 mirrored 1973 to 1975, then 2020 to 2022 was 75 to 77. And now we're beginning that breakout that back in the 70s took gold up a massive amount. So you can see the breakout here, right? And what you did was you went right up to the technical resistance, which was double top. So this is exactly behaving how gold should in terms of charting. Double top resistance right here, price has to come back in. Now, generally what you see is you see what's called a retrace to the scene of the breakout. And this trend line is that scene. So I'm still expecting gold to come in just a little bit more over the next couple weeks, and then you're gonna get your best buying opportunity, all right? Now, by the way, if you're someone who is going to hold gold for a year, 5 years, 10 years. It doesn't matter whether it falls $50 here or not, right? We're talking from my perspective of being a trader, where I need to get in as close to the lows as possible to maximize my near-term gains. But bottom line is, I think anything 1850 down to 1825, huge buying opportunity, and then you're going to see the next big move up. And that move should take us easily through this double top high of around 2070 and probably take us towards that $2,500 level, which I still have a target on for the end of this year. It's the one place where in this market environment, I feel like I could go to sleep and sleep relatively well. If I'm in Bitcoin, I don't know if overnight it's going to drop 10%. If I'm in stocks, who knows what's going to happen tomorrow? Is it going to be a Tesla where it's down 12%? NASDAQ today was down over 3.5% alone. After hours, it was at one point down another 2%, bounced back from that point. But again, gold is definitely the safe haven. It doesn't move that crazy. And I think there's a lot of upside coming in the remainder of this year. We're seeing in silver here is exactly what I talked about happening probably in the next week or two in gold, which is it's retracing to the scene of the crime or the scene of the breakout. So I love showing this chart here because this is almost like a peek into the future of gold, where you have this downsloping trend line. You broke out above it here, and then you came back in and you're right back to that point. So in terms of a buying opportunity, this I would act on in terms of silver. I would be a buyer here of silver. It's major retrace support here. And I do think after this, you're going to start to trend higher on silver and potentially make your way back to 30. So I do think silver is a good opportunity here. There's lots of support here. The only thing I'd be careful of, so this is kind of the trade setup, right? So see this lower trend line right here. You just, if silver comes down in here, okay, no big deal. Down here, no big deal. You just don't want to see silver get below 21.5. That would be a point that would concern me, that it's going to make a bigger break to the downside, and probably at that point go all the way down to like 18 or so. But honestly, right now, I don't even think you need to think about that. Right now, it's on major support right here, this orange trend line. This is a technical buying opportunity. So I think the biggest thing on silver is you just have to be fully aware as an investor that it's also industrial based, right? So yes, it's a store of safety. It tends to move more wildly than gold. So you have to take that into account when you're allocating capital to it. But I do think at this point you go into it just with maybe a little bit of a less percentage. So for instance, in my portfolio, in general, I like to have as much as 10% of my portfolio in gold. I'd probably only do about 5% in silver because it does have more volatility and more unknowns due to the industrial side. we continue to trade inside of this little wedge pattern. And a wedge pattern, all a wedge pattern is you're connecting the highs of the recent moves and the lows of the recent moves. And it creates this kind of triangle / wedge pattern. And what you watch for on this is basically which way does it break? So does it break to the downside or does it break to the upside? If you break to the upside, this could start trending maybe back to 115 or so. My guess is you're going to probably see a break to the downside. And again, as the Fed tightens, as the economy kind of starts to sputter due to a stock market that's not performing like it has for the last few years, the idea is that the economy is going to slow. And the global economy, we know that Europe is suffering due to the Russia invasion of Ukraine and the supply chain and all of these issues. So it's very hard for me to think about a situation where oil could break out above 130. And I'm much more likely on the side that oil, because of a lack of demand in a slowing global economy, that you're going to head lower. So bottom line is you're trading in a range right now. You can see the most volatile move was at the start, then less volatile, less volatile. Now you're looking to see which way it breaks. I think you're going to end up breaking to the downside and heading to 84. And then eventually, I think by November, by the midterms here in the US, I think it could be $75, $76 a barrel. Actually coming into some very, very interesting support down here. There's a big trend line around this 50, 55 level. So 55 gets hit, and I'm a buyer of this in the near term. I think it's important to understand why. So everyone's saying, well, if everyone's switching to electric vehicles, why is lithium on the downward motion when that's a big component of the battery? And the answer is just simply that the fear is that the economy is slowing. People will be buying less cars, less electric vehicles. Electric vehicles still tend to cost a little bit more. So the idea is that people will just have less money to spend. And so therefore there might be less demand out there. Ultimately, I think that's a short-term situation as all these car makers are switching over to all electric over the next 10 years or so. So I think longer term lithium is going to be fine and outperform. But I do think that, again, this fear of a slowing economy, the Fed, the central banks tightening, that's going to lead to this downside continuing just in the short term until you get to this 55 level on lithium. When people react emotionally, they do the wrong thing. They get in at the highs when everyone's talking it up, and you go into a store and your buddies are all telling you about it, or vice versa, or even on Twitter, right? We know Twitter, when Bitcoin was at 65, 68,000, everyone was on it, and so many people bought in because they were emotionally triggered. So the best investors in the world are the ones that do not have that emotion, that attachment to any stock. You treat a stock like a vehicle for you to make money. Therefore, you need to analyze it accordingly, buy low, sell high, and have major factors as to why you're investing. A valid factor is not, hey, I saw it on Twitter. I'm sorry, that's not a valid factor, right? So it has to be, all right, well, what is the chart telling me? What are the fundamentals? Is there the long-term demand for lithium? What's the angle for gold? Why would you invest in gold? And the answer is, well, inflation, right? Inflation, I think, is going to be sticky. Yeah, it'll come down from 8 to 10%, but it's going to be sticky around 5 or 6%. So that's long-term, 10 years of inflation probably in that range. All of these type of things, the market's kind of crashing, or not crashing, but collapsing, that makes people want to move to safety. So these are valid reasons versus, oh my goodness, everyone's talking it up. That's not a valid reason. Again, it depends on your time horizon. For people in 2007 going into 2008, it took them quite a while to recoup their money. Same thing of the dot-com collapse. It took many, many years for the NASDAQ to finally come up and take out, I think it was as much as 10 plus years for the NASDAQ to come back up. But if you have 20 years, 30 years, you have the time is on your side. The markets will inevitably go higher, continue to be smart. And what I always say is, during rough times, it's the scariest to put money to work, but that's when you need to. So think about dollar cost averaging. If you're in Facebook, right, or Meta, and it's down significantly and you're in from a higher price, as it comes down, just throw a little bit of money on a monthly basis into it, bring that average down. It's a quality name. They're getting into that kind of meta side of things. It probably will be fine in the future. One of the things to remember is that as a good investor or trader, you never want to be emotionally biased, right? So when I say I'm bearish in this next 3 to 6 months, it's because the chart is telling me that there's a formation where probabilities favor that. And that formation, simply put, is what we call a bear flag. You have the big drop from 69,000, and then you see this tight range that it's been trading in. That's known as a bear flag. And usually if you looked at 100 of these charts with this same formation, about 80 of them would break to the downside like this. So that's where the bearish stance comes from. I will say that I'm a big believer in Bitcoin and blockchain technology. So I think that after we see a flush out and after we get kind of a .com reckoning for the crypto space, I do think Bitcoin is off to the races and does become that digitalized gold that everyone hopes it does become. Now, the big break is going to come if this trend line here gets taken out. So if you get below, I would say like 37,500 and it stays there, that's where you probably get the next leg down. Short-term support, you're going to have at 33,000, which is that former low from just a few months ago from January. And then if it takes that out, the next spot is going to be around 29 to 30,000, which was the low from 2021. Now, the only thing I want to say is that you'll get bounces at these levels, but I do have a target of 20 or sub 20,000 on Bitcoin, unfortunately. So I do expect it to go.
Did you say sub 20,000?
20 or below, yes.